Here is our top 5 topics this week in financial markets. The U.S. unemployment rate has now been below 4% for 23 straight months, the longest streak since the late 1960s. However, beneath the surface, the labor market is deteriorating quickly. Despite the strong headline non-farm payrolls number last week, the number of full-time workers plunged 1.5 million in 1 month, its lowest level since February 2023. Meanwhile, the number of part-time workers has soared 762,000 and has reached the highest level on record. So, part-time jobs have surged. But how significant was the losses in full-time jobs? Well, in terms of month-on-month changes, the percentage drop in full-time workers was the second worst since 2009. Only April 2020 during COVID was higher. In the manufacturing world, only one industry reported growth in December per the ISM Manufacturing PMI report. This is the worst reading since April 2009. This speaks to why we have seen such a slowdown in full employment. However, it also shows the current health of manufacturing cannot get much worse than it is today. With Fed rate cut expectations having surged in recent months, a re-acceleration in the economy is seemingly underpriced here. This is especially interesting as a rebound higher in interest rates would likely be an economic headwind for the back half of 2024. We see a near-term rebound in economic activity that only makes a more significant slowdown later this year more likely. Historically, if investors saw a slowdown in the USA on the horizon, then Europe or China could act as an investment safe haven. However, Europe is in even worse economic shape than the USA. Germany housing prices have plunged lower over the past 12 months. China's slow recovery is weighing on Europe, and so is energy-intensive investment. Following the spike in energy and electricity prices due to Russia's invasion of Ukraine, Germany's already hurting manufacturing sector has been hit hard. Importantly, you would think German equities would have been crushed lower this year. Nope. They are just off the highs. It is hard to see the bull case for European equities that are at the recent highs due to the recent bond rally when economic growth is so scarce. The US seems to the least dirty shirt in the laundry, but is it really attractive with everyone crowded into expensive big tech names? Many commodities are among the cheapest and most shorted assets among the fast money crowd coming into 2024. We believe risk-reward in the commodity space is attractive for the coming 12 months. Unlike equities, many commodities faced a decade-long bear market from 2011 to 2020. This asset class has huge upside potential if China, Europe, or even US manufacturing see a pickup in demand. Keep in mind, on the supply side, growing tensions in the Middle East are likely to push up costs. In recent weeks, we have already seen many ships reroute away from the Suez Canal. Our final topic to key an eye on this week is not seeing enough attention from the mainstream financial media. Corporate insiders are selling stock in big numbers. The insider sales-to-buy ratio hit 63 this past week, an extremely high reading. This should serve as a major warning sign for those who are bullish right now. Let's make this simple as possible. The people running the companies that retail investors are currently piling into are dumping shares at a historic rate.